Welcome to the Learning Square. Investing may be confusing to many people, especially young investors. It is because they invest with little knowledge, and hence have a high chance to make some poor decisions, which could result in them losing money. In today's video, we are bringing to you 6 investing advice, consolidated directly from some of the most respected and successful investors. We believe that these advice will help you to manage your investments in a better way, and go on to become a successful investor. So, let us begin. Do your homework. This is the first, and probably the basic investing advice that anyone can give you. It is always very important to do proper research prior to investing. For the famous American investor, Peter Lynch, an investment done without proper research is like playing stud poker and never looking at the cards. Learning is key, and always do your due diligence before investing. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. This advice comes from Jack Bogle, who was an American investor, business magnate, and a philanthropist. This rule teaches us that losses are a reality of the stock market, and one should always be ready and prepared for the losses. Never invest an amount that you cannot afford to lose. Be patient with winning trades. Be enormously impatient with losing trade. This rule from Dennis Gartman is very useful for young investors and day traders who try to make quick profits and sell as soon as they see the first sign of profit. What is important is to let the winning trade run, and get out of losing trade quickly. It advises us to be patient when our trades make profit, and also asks us to be impatient when the trade is losing. This is why setting up a stop loss is always recommended, so as to avoid huge losses. It's far better to buy a wonderful company at a fair price, than a fair company at a wonderful price. One of the most common mistakes that young investors do is to buy shares in a company just because the price is currently low, without having any idea on the company fundamentals. This advice given by Warren Buffett asks us to analyze a company before analyzing its price. One needs to analyze the company first by evaluating its balance sheet, checking its fundamentals and management, and after there is confidence in the company, the other factors like the price can be evaluated. Be fearful when others are greedy. Be greedy when others are fearful. When most investors are bullish on a stock, the investor rush pushes the stock price up. This advice asks us to be cautious in this case, and not to chase a stock when it is already high. The opposite also holds true. When most investors are bearish on a stock, the asset valuations are low, as everyone has already sold. This may present a good buying opportunity. So, don't just follow the herd, analyze and make smart decisions. Invest for the long run. We learned this rule from Charles Ellis, the American investment consultant, as well as from Prince Al-Waleed bin Talal, the Saudi Arabian investor. They both have had success investing for the long run. For Charles Ellis, the average long-term experience in investing is never surprising, but the short-term experience is always filled with lots of surprises. He believes that investment in a good company is sure to profit you in the long run. So, let us quickly summarize the advices that we just saw. These advices are in fact investing rules, which one can always follow while investing. 1. Do proper due diligence. 2. Never invest an amount that you cannot afford to lose. 3. Set up proper stop losses and let the winners run. 4. Evaluate a company before going for its price. 5. Don't follow the herd. Be cautious and trade smart. 6. Invest for the long run. These are tried and tested rules that the investors have used to achieve success. We hope that you will keep these tips in mind as you begin investing. Happy investing, and happy learning. Thank you.